Okay, this is a big deal, and this is really cool. Something people don't think about a lot. This is called correlating assets, non-correlating assets, right? Inverse correlation on the assets. And correlation just means they correlate. They kind of run together in lockstep. I had a guy send me an email, good guy, student, brand new though, and he just wanted to ask some technical analysis questions on his, on his mutual funds that he had. And so he sent, me a list of these mutual funds just to look at charts. I can't give financial advice, so I don't. But, looking at his charts. And, within myself, I kind of mused and thought, this is all the same. Here he's got all these mutual funds. He just will be in one. S&P is down about 9.6 on the year right now, this taping. His fund was down 9.7 and I think 8.9. So, just basically, as I went through all, they're the same stuff. Well, think about it. We might go in. Here's the problem with that. Maybe we go in to do some trades here. And here I have the SPX, and I want to do, a bull put credit spread, which means I'm going to get paid $200 to take this trade. And bull means I want it to go up, of course, right? And I'm going to get credit for the spread. Now notice this. Let's just do the trade quick. I buy one. Well, let's first do the income. I sell one September 1165 strike put, which simply means that I have an obligation now to those guys to let them sell me this index. Now this is a European cash settled index, but you get it. I'm gonna get some income here from this baby right here. Now also right here we're gonna buy, and this is not a trade I would do. It's just one I threw up for an example. I didn't have time to research a really good one, but for risk management, for correlation, it really doesn't matter. So don't go out and think these are great trades, because this is not a good trade right here. Okay, this is not one I would like. So especially in this market, because it's it's kind of volatile and headed down. But let's just manage the risk. So we're going to sell this put for income, okay, and we're going to make 40 bucks. Then what we're going to do is we're going to buy some protection down here at the 1160 level. So we're going to buy a put. So that means that if this guy wants to sell it to us at 1165, we're going to be able to sell it to some other guy at 1160, right? And so my risk on this is 292. Now why not 500? Well, because I'm earning some money on this spread right here, right? I'm getting a credit of $210 here. If you see the difference between 38 and 4070 is $2.10 times 100 shares per contract. That means I'm going to get $210 here, okay? So that's 210. So you take that 210, 500, oh my gosh, look at that, right on there, 290. So the most I can lose in this trade is 290, and the most I can make in this trade is 200. Obviously, I want it to go up, hence bull put credit. Obviously, I make $210 credit between these two. I receive 470, I'm paying out 360 for the insurance. But what I want you to understand is two things. Number one, I'm buying this for insurance, so if this goes down and down and down, there's a limit to what I can lose, okay? But here's your thing. Let's say I do the same thing with the Russell 2000, okay? RUT, and I load that one up, same trade. We'll do a bull put credit spread. Same thing here, right? I'm up here, I'm making money. Once it drops 680, I start losing money. Lose, and then it caps here. Let's say I do it on the NASDAQ, the Qs. Let's do it on the exchange traded fund. Kind of an uglier one here, but same idea though. Down we lose, up we win. It's just how it goes here. So it doesn't matter whether I'm doing any of these. They're all correlated, aren't they? All correlated, and if I could type, it'd even work even better. Okay, so let's get that in there. Go ahead. Okay, so check this out right here. Let's go back to this right here. Well, I could lose, no matter which one I do, they're in lockstep. If I do all four of them, and I've seen guys do this, they'll do, iron condors or spread trades like that. They'll do one in the Russell, one in the Nasdaq, one in the S&P. I've done it as well, and I can understand where you do some for different premiums at different times. But the fact of the matter is, if the thing drops, this is dropping too, and they're all correlated together. The market drops, you're exposed. See, so what a person might do is do some non-correlating assets. Now, notice this right here. If you're in the S&P and you drop, 15% here, you're doubling on your VXX. Now, this is called the VXX. This is something that I'll use from time to time. You want to be careful with this because it will lose money over time because of how it's set up, which is important to know. But let's just get rid of this here, and let's bring up the VXX here. This is the VIX, the actual index that traces volatility, and then this is its ETF right here. Okay, and this is the S&P 500. Notice the inverse correlation. When this is down, this is up. When this is up, this is down. Well, when the market fell apart here, I actually had some of this. I was in a trade in the SPX right here that I'd put on right here, expecting it to go sideways, figuring they'd get the debt ceiling thing figured out. I knew they would buckle. What I didn't think is that S&P would really downgrade us yet. I thought they'd wait a little longer before it got a little uglier. So when this fell, I'm losing money here. But luckily what I'd done is, since as this got closer and closer and the news of the S&P downgrade being a possibility got bigger, I thought, you know what, I'm going to buy some of this just in case. So when this dropped, in this particular trade, I lost like $1,200, and that's not bad, it's just one trade. But this one right here, it soared, and I made thousands of dollars on this one. Look at this. This went from an index of 20 to 45. So this again falls 20%. This doubles. So check this out. Let's go to the risk graph again. Get rid of this. Don't want to confuse anybody. And let's go to the SPY. And this is not the trade I had. Mine was more complex, but I want to take the time to build it right now. You still get the principle. That's all we're teaching. And let's go with a bull put credit spread where we get credit. And again, we see, let's get rid of that baby. We see that if this goes down, we lose. Well, I can have two layers of protection here, two layers of hedge. Number one, I sell this one for income. I buy this one for protection. So the put I buy puts a line in the sand right here where I can't lose any more. Notice the point. It's at 1160. 1160 put, right? The most I can make is 1165, so everything above here is the same. So it looks like I got a profit potential of 210, right? I can drop it down here and lose up to 290, and that makes sense because I received 210, $5 spread here times 100 is $500. So great, but I don't want to lose this 290. So if this falls, I got, and if this falls and I decide to exit the trade right here, I've lost $98. If I exit the trade right here, I've lost 178. So look, I can go out and I can buy myself some of that VXX if I want, right? And this explodes in value if this one goes down whatsoever. And what's nice is this will deteriorate over time because of how it's set up. But in the short term, if I see turbulence, it explodes in value, man. So maybe I buy a little of it. If this stays high, great. I get to sell it later on close to what I bought it for. Maybe I write a covered call on it, get paid, right? Get paid for buying my insurance or for holding my insurance. Maybe I even write a put to have this put to me, if I have enough time. But the point is this explodes in value, just like an insurance policy. And that's what we're talking about, right? We're talking about hedging, talking about managing risks. So these are non-correlating. These are inverse correlating. Speaking of inverse correlation, check this out. Here you got the Dow Jones Industrial Average. You don't want to go short? Fine. Buy its inverse ETF, inverse correlation. Notice these are exact mirrors of each other, aren't they? And so how sweet is that? This is the Dow Jones Industrial Average, DIA. They call it the diamonds for short. This is hilarious. They name its inverse the dog. So when the market's acting like an old dog howling away, barking, hey, its bark is worse than its bite. We can buy this ETF and actually make money in the down market by going long the dog instead of going short. This over here is the IYF. It's a financials. And this is really a cool one called the FIZ. And this is 3 times leverage. Now again, notice the hedging potential. A couple things we could do here to hedge. Let's say you're in the financials, okay, and it's stinking for you. What could you do? Well, you're in this at $50, 1,000 shares. That's 50 grand. You want to waste 50 grand? What do? Well, look this. This falls like $3 from maybe 49 to 46, right? We'll call it 49 to 46. Falls $3, $3 down here. Look at this, $12 up here, 51 to 63. So this is 3-to-1 leverage. If it falls $4 here, it's going to rise $12 here, which means you buy less of this to hedge this. Or better yet, if you're nervous and you know there's something coming up, that's kind of scary, Bernanke announcement, whatever, buy a call, cheap. Buy a call. It's leveraged, right? Three times. Buy a little cheap call. If this tanks, this goes to the roof, and you have leverage on their calls. So again, I don't care that you understand these individual trades. That's not what this is for. What I care about is that you just kind of get the idea that, hey, I can use these options to manage risk. Options are largely inexpensive. They don't cost thousands of dollars. A few $100 you can really hedge something like that. So you got correlating, non-correlating, inverse correlating. And I do non-correlating all the time. Check this out. Here you got some non-correlating assets, right? You got SLV, for example. Maybe what I want to do is this. Maybe I want to do one of these trades on SLV, right? And so I go here and get rid of this VIX, get rid of this VXS, and I just go SLV. And I say, hey, I think it's going higher. I want to get paid right here. I want to make this, $48, and I want to, I got this $50 risk, about 1-to-1 on this. And if it goes down, I start losing. If this is my break-even point, at 0, if it goes below 40, 50, I'm really in trouble. So, what do I want? Maybe I want to hedge that, right? But here's what's cool. If the Dow goes down, this can still win. That's what's really cool, is I can be in this one, but if the Dow goes down, it doesn't pull this down. Why? Because it's non-correlated. See, if we look at the chart and the Dow or the S&P drops, this silver's still rock and rolling. Look at the 3 or 4 weeks here. Look at the 3 or 4 weeks here. This is going up while this is going down, right? Another thing is, look, here's the US dollar, okay? Actually, it's the inverse of the US dollar. So while this Dow Jones tanks, maybe the dollar sometimes tanks, sometimes it doesn't. Usually when this tanks, the dollar gets stronger. So I could go with the dollar, or I can go with this inverse of the dollar. Or I've got commodities. Again, the Dow's going down. This is dollar's kind of flat, but the corn is going up. And so I could have a trade like this. I'll show you. I could build a trade on every one of these. I could build one on the S&P that looks like this. I could build one on corn that looks like this. I could build one on the dollar that looks like this. I could build one on, and I could have the same cash flow on time decay, right? Because that's all this is letting these options run. I can have the same cash flow on time decay. But if I had all of my time decay trades correlating, the underlying of one, I'm getting crushed in all of them. Here, the time decay gives me a better chance of only having 1 or 2 drop, and I can hedge those as well. But you get the idea with the risk management. Correlating, non-correlating. Very cool concept. We'll learn more about it as you get further along. Position sizing. Casinos are smart, don't you think? I mean, all these kids say, I want to go in there, and the dad says, look at the size of those buildings. They must know what they're doing. They get a lot of money. So you're in blackjack. The thing they do is there's a couple things that they got to watch out for. Number one, what if someone comes in there with some serious cash, He's a gambler. He loves to gamble. Drops millions of dollars down there, gets one lucky thing and walks out. Gets one lucky hand, walks out. Wipes out their whole week. Wipes out their whole week. You can't have the high roller coming in, dropping big time cash on one spin of the wheel to get a thrill, then walking out with $1 million, $2 million. Can't have that if you're a casino. You've got to put a limit on what they do. Make them spread it out. Make them spread it out with smaller bets over time where your numbers can work for you more and more and more, right? Put a table limit on it. Make them spread it out. Another problem casinos have is this, doubling down. If you go in and you bet, let's say $5 and you lose, well, maybe you put down 10 next time, and if you win, you got your 5 back plus more. Well, okay, you lose that one. Now you're down 15. Great, bet 30. And if you win, you get it back plus more, right? You just keep doubling down. And you can go, $100, $200, $500, $1,000, $10,000. As long as you keep betting bigger and bigger each time, sooner or later you're going to win and get all the money you lost back plus more. Well, they got to put a stop to that. So they put a table limit on there, which means, okay, we'll let you go from 5 to 10 and 10 to 20 and 20 to 30 or 20 to 40 and 40 to 80, but we're not going to let you go past 100. That way, when the casino gets on their little run, which they do, and they win 5 hands in a row, it cleans the guy out huge. Best thing ever happened to casino. When the casino sees a guy doubling down, they know they're going to get rich. They're going to get rich huge. Why? They put a limit on how much they can lose in each hand. Why don't we do the same with each trade? Why don't we put a limit? Look, check roulette out. Roulette has 2 basic things that we can look and see it make it work. Number 1, the win-loss percentage. They're going to win more than they lose. Bet on 18, you got 20 chances to lose if you bet on black. Bet on red, you got 20 chances to lose if you bet on red. Bet on green, you even give you odds, 36 chances to lose. So they're going to win more than they lose. Yeah, they'll lose some, but they'll win more than they lose. Combine that with a table limit, $100, $500, whatever it is. If the table limit is 500, the minimum bet's going to be 100. If the table limit, they'll mess with those numbers, man, and it gives them an advantage, and that means earnings. We can do that. Yeah, we're not casinos, but we can do it. How do we get our win-loss percentage increased? Fundamental technical analysis. Let's learn charts. Let's see what's most likely. Let's learn the ascending triangle, the double bottom, cup and handle, stuff like that. Let's find trades that are high probability likely trades. Let's trade with the trend. Let's trade with good fundamentals. And then let's get ourselves a tolerance of position size. Now, this is just an example. I can't give financial advice, and 1% is just arbitrary. Yours might be 2%, might be 0.5%. But let's just look at this. Let's draw some numbers on the screen, shall we? Okay, let's look at one side here. Let's say you got an account. Let's put it in blue. Let's say you got an account of 100 grand. Okay, that's your account. You got a $100,000 account. And you decide that your risk tolerance is 1%, which means the most you're going to be able to risk in a trade as far as stop loss is concerned is going to be $1,000. Okay, so let's look at the downside first. Let's say that we've got an entry at 39 and an exit at 37. So that means you could lose $2 in this trade. Well, if the most you can lose in one trade is 1,000, then let's put our position size at 500 shares. That way, if we lose $2 on 500 shares, we've only lost what? $1,000. And so now I know that that matches my tolerance, which means the most I can do, and I don't have to do 500, but the most I can do in my account is 500 shares, because if it doesn't work out, I'm going to lose $1,000. That's going to leave me what? That's going to leave me an account that has $99,000 in it minus commissions, right? Which is pretty close to what I had in the first place. And I can go out and trade another day. Now, okay, so when I lose, my account looks like this. But here's the thing. Check this out. Let's go to green. Let's say that I hit my target. That means I'm going to make $6. And how much was my position size? $500. Right? And so that's going to be $3,000, I do believe, right? $3,000, because $6 times 500 is going to be $3,000. So my account will look like, or your account will look like $103,000, right? And so this is survivable. This is happiness. You do this on 10 different ones, non-correlated. See, if I do this on 10 that are correlated, then they're lose. This works better when you have good fundamentals, good technicals, and you're non-correlated. Very cool stuff, don't you think? I think this is cool stuff. That way, if we're non-correlated and we have good fundamentals and technicals, we get more of this than we get over here like this. So very cool stuff to begin to study. Of course, if I didn't have all this stuff on the screen, you know what, let's just get rid of it all. There we go. Okay, so it's non-correlated, correlated, and position sizing. Very cool. Okay, so this is our risk management toolbox. Are there others? Oh man, delta hedging. It just sounds cool. Does it sound complex? Yeah. Is it? A little bit. But nothing you can't learn. Delta neutral, or neutral delta, delta neutral trading. Rebalancing it every day using your delta. Very cool stuff. You know, at this point, I hope after these you've had a little trust in some of the things we teach. Gotta get an education. Gotta get our education and learn it. Delta hedging, awesome. Let's talk about education. The traditional thought, and there's truth to this, don't get me wrong, is that, you know, here you got your cash, you know, your treasuries. Here you got your, in fact, treasuries probably more conservative than cash because it at least gets something supposedly guaranteed, so we'll cross cash out. Here you got your treasuries. Here you got your mutual fund. Here you got your stock. Here you got your option. Here you got your Forex market. And they're saying, hey, in order to get these big leveraged rewards, you know, I got to be way up here on the risk scale. That's what they think. But like I say, it's not the vehicle, man. Who's flying the plane? Who's trading the Forex? There's some people that don't know what systemic risk is trading mutual funds. Other people know all the risk trading Forex. These guys will probably have a greater chance of getting home on their trades than these guys will. They're getting more reward, but they have less risk because they know how to hedge. They know how to do it. So very, very important to know that ignorance does play a role in this, in my opinion. It plays a big role in it, in my opinion. The more education we get, I think we can manage that risk effectively. That's just my view, and I you know, you can agree or disagree. But I love education. I hope you know I love teaching these. This is fun. I've enjoyed it tremendously. So, education, that's your big one. Holy cow. Congratulations. You are now no longer ignorant. No, we're just going to cross this whole thing out right now. You are aware. And now we get to move to competent. Let me tell you a little bit about some of this advanced stuff. If you have an interest, you can contact me. You know, I'm thinking about doing a class just on education and just say, hey, you know, here is how this works. If you have an interest in that, email me, and I'll build a little class like this that shows people. This is more involved. I'll tell you that right now. There's a higher tuition. Is it worth it? Yes. And most of these classes are taught by the people who have taught me that I can hook you up with. I have people that teach them for us. Great alliances, great stuff. But these are taught live. You know, this stuff here we can do with these recordings. Okay, this stuff here we got to have a little Q&A, don't you think? Got to have a little interaction, isn't that right? And these advanced classes, they go about 6 weeks, and they're held all over the United States. They're held online. You can do it online, but we want to do it live, and we have stuff we can get together for, stuff like this. We can hook you up with mentors and market labs. It's time that we have to, you know, we have to do this stuff live, because it's really where you get the specifics and the training. So if you have an interest in doing stuff like that, you know, people say, hey, is it more expensive? Yeah, it is. And is it worth it? Yeah, it is. It's less than going to college, stuff like that. But you know, hopefully in these 4 basic classes, you've got a taste for what can be done, a little bit more aware of some of the strategies. Now it's time to get these strategies down pat and get to proficiency. So, if you have an interest in some of this stuff, go ahead and email me. I can set you up with we can do a little consultation. We can see where you're at. Maybe you've got a little money behind you. You want to make it grow or preserve it. Learn a little bit about more so you can talk to your broker better. Maybe you're starting out square one. Doesn't matter. We can get you a consultation and help you with whatever your education needs are, your budget, your goals, whatever you need. So hope you enjoy how we do the training. I certainly enjoy it, and we'll look forward to speaking with you live next time. Get to know you even better in phase 2, competence, phase 3, proficiency. Look for some great return on investment with your education. Awesome stuff. Congratulations. You have just completed basic risk management. Hey, way to go. Had a lot of fun. Have a good one.